Untangling the web. What is group accounting? Group accounting can often feel like a complex puzzle with too many moving pieces. However, when you break it down into simple, manageable rules, it becomes much clearer and more intuitive. This essay is designed to demystify the 5 key international public sector accounting standards: IPSAS 34, IPSAS 35, IPSAS 36, IPSAS 37, IPSAS 38 that govern group accounting. These standards provide a comprehensive framework for public sector entities. They dictate how to prepare financial statements when an entity has relationships with other entities, such as subsidiaries, associates, joint ventures. By reading this guide, you will gain a clear and confident understanding of the core principles behind each standard, complete with simple examples and a practical checklist to support your work. So, what exactly is group accounting? At its heart, group accounting is the process of creating a single set of financial reports for a collection of related entities. This collection, known as a group, consists of a parent entity and one or more other entities that it controls or influences. The primary goal of this process is to present the group's overall financial position and performance as if it were a single economic unit. This means combining all the assets, liabilities, equity, income, expenses of the parent and its controlled entities. This approach helps users of financial statements, such as legislators, funders, citizens, to see the complete financial picture of the entire public sector operation, not just isolated parts. The concept is similar to taking a wide-angle photograph instead of a series of close-up shots. A close-up of a single government agency might look financially sound on its own. However, without the wider view, you might miss the fact that it is supported by a struggling state-owned enterprise or has significant off-balance sheet commitments in a joint project. Group accounting provides that essential wide-angle perspective. It ensures that the financial statements reflect the full extent of the resources the parent entity controls and the obligations for which it is responsible. This holistic view is crucial for transparency, accountability, sound decision-making in the public sector. Without group accounting, the true financial health of a government or public body could be easily obscured. An entity could potentially shift debts or unprofitable activities to a subsidiary to make its own financial statements appear more favorable than they are in reality. This is why standards are so important. They establish clear and consistent rules that prevent such manipulation. By requiring the consolidation of all controlled entities, group accounting ensures that all assets and liabilities under the parent's control are reported. This gives stakeholders a faithful and complete representation of the entity's economic activities, fostering trust and enabling more effective oversight of public funds. Why it matters. The power of a complete picture. The importance of group accounting in the public sector cannot be overstated. A modern public sector group is often a complex network of interconnected entities. It might include central government ministries, local councils, specialized agencies, public corporations, state-owned companies. If you assess the network by looking only at each entity's individual statements, you'll likely miss the full story. It's like examining one person's bank account to judge a whole family's finances. You would not see shared debts, combined income, financial support flowing between members. Group accounting provides that complete family picture, a consolidated view bringing all entities together. This complete picture is vital for protecting the interests of users of public sector financial information, legislators, policymakers. For example, knowing total debt across the government group is critical for assessing fiscal sustainability. Lenders, credit rating agencies. A clear consolidated view helps them understand the full range of risks and obligations. Group accounting is a powerful tool for transparency and accountability. The Solo Act, IPSAS 34. Separate financial statements. IPSAS 34 focuses on a specific type of financial report. These are the financial statements prepared and presented by a parent entity on its own. The parent accounts for its investments in subsidiaries, joint ventures, associates without combining their financial data. These are presented in addition to consolidated financial statements, not as a replacement. A parent required to produce consolidated statements must do so, but it may also choose to present separate statements or be required by local regulations to present them. This standard provides the rules for how to do that correctly. The core rule is how a parent measures its investments in its separate financial statements. The standard gives the parent a choice of accounting policies: measure at cost, IPSAS 29, often fair value, or use the equity method, IPSAS 36. apply the chosen policy consistently for each category of investment. Key takeaway: the parent reports its investment as a single line item on its balance sheet rather than adding up the investee's individual assets and liabilities. Example: a central government's Ministry of Transport. The ministry owns 100% of a state-owned railway. In its separate statements, it will not include the railway's trains, tracks, staff costs in its own accounts. Instead, it shows a single investment line on its balance sheet. If it chooses the cost method, it records the investment at the original price paid. That single line represents the ministry's interest, but it doesn't reflect the railway's day-to-day financial reality. A common pitfall is confusing separate and consolidated information. Separate financial statements must be clearly labeled so users don't mistake them for group financial statements. Totals for assets, totals for revenues in separate statements will differ significantly from consolidated totals. Another error is inconsistent application of accounting policy. If a parent measures subsidiary investments at cost, it should generally apply that policy to all subsidiary investments to ensure comparability. Bringing it all together, IPSAS 35 Consolidated Financial Statements. IPSAS 35 Consolidated Financial Statements is the cornerstone of group accounting. This standard mandates the preparation of consolidated financial statements, which present the financial information of a parent and its subsidiaries as if they were a single economic entity. The fundamental principle is that if a parent entity controls one or more other entities, it must present consolidated accounts. This requirement is not optional. The purpose is to provide a holistic view of the economic resources controlled by the parent, its obligations, and the results of its operations, ensuring users get a complete and undiluted picture of the entire group's financial affairs. The core rule of IPSAS 35 revolves around the concept of control. A parent must consolidate all entities it controls. Control is not just about ownership, it is a more nuanced concept. According to the standard, an investor controls an investee when it has all three of the following elements: power over the investee, exposure to variable returns, and the ability to use its power to affect the amount of its returns. Power generally comes from rights that give the parent the current ability to direct the relevant activities of the subsidiary, those activities that significantly affect the subsidiary's returns. This is a critical definition that requires careful judgment. Let's take a practical example. A city council establishes a separate, legally distinct agency to manage all public parks and recreation facilities. The council appoints the majority of the agency's board members. The council has the power to approve its annual budget and key operational policies. Because the council has power over the agency and is exposed to its financial performance, for example, it has to cover any deficits, it controls the agency. Therefore, under IPSAS 35, the City Council must prepare consolidated financial statements that combine all its own assets and liabilities with all the assets and liabilities of the Parks Agency. Internal transactions, like a grant from the Council to the agency, must be eliminated. There are several common pitfalls when applying IPSAS 35. A frequent mistake is failing to eliminate all intercompany balances and transactions. For instance, if the parent has sold goods to its subsidiary at a profit, that unrealized profit must be removed from the consolidated inventory and profit figures until the goods are sold to an external party. Another error is not applying uniform accounting policies across the group. For consolidation to be meaningful, all entities within the group should use the same accounting policies for like transactions and events. If the subsidiary uses a different depreciation method, for example, adjustments must be made during consolidation to align it with the parent's policy. While IPSAS 35 deals with entities under a parent's control, IPSAS 36 addresses situations where an entity has a less dominant relationship. This standard prescribes the accounting treatment for investments in associates and joint ventures within an investor's consolidated financial statements. An associate is an entity over which the investor has significant influence. A joint venture is a specific type of joint arrangement where the parties involved have rights to the net assets of the arrangement. Significant influence is the power to participate in the financial policy decisions, operating policy decisions, but is not control or joint control over those policies. The core rule of IPSAS 36 is the mandatory use of the equity method to account for these investments. The equity method is a way of reflecting the investor's ongoing interest in the investee's performance. Under this method, the investment is initially recorded at cost. Subsequently, the carrying amount of the investment is increased to recognize the investor's share of the investee's profit, decreased to recognize the investor's share of the investee's loss. For example, if an investor owns 30% of an associate, it will recognize 30% of the associate's annual profit as part of its own income in the consolidated statement of financial performance. Distributions received from the investee, like dividends, reduce the carrying amount of the investment. Consider a public sector example. A regional development authority owns a 40% stake in a local airport company. The remaining 60% is owned by private investors. The authority does not control the airport, but through its 40% ownership and a seat on the board, it has significant influence over its strategic decisions. In its consolidated financial statements, the regional authority cannot simply combine the airport's assets and liabilities. Instead, it must use the equity method. If the airport company reports a profit of $10 million for the year, the authority will record investment income of $4 million, which is 40% of $10 million, in its consolidated results. A common pitfall is applying the equity method incorrectly or in the wrong context. For instance, practitioners might mistakenly use the equity method in the parent's separate financial statements. While IPSAS 34 allows this as a policy choice, the primary application of the equity method under IPSAS 36 is for consolidated financial statements. Another frequent error is forgetting to assess the investment for impairment. If there is objective evidence that the investment in the associate or joint venture may be impaired. For example, the investee is facing significant financial difficulties. The investor must perform an impairment test and recognize a loss if the investment's recoverable amount is less than its carrying amount. IPSAS 37, Joint Arrangements, provides guidance for accounting interests in jointly controlled activities. Joint control, contractually agreed sharing of control, exists only when decisions require unanimous consent. Collaboration is common in the public sector. 2 municipalities co-funding a water treatment plant, several government agencies collaborating on a research project. IPSAS 37 ensures each party's rights and obligations are reflected in financial statements. 2 types of joint arrangements: joint operations, joint ventures. Classification depends on parties' rights and obligations. Joint operation, parties, joint operators, have rights to the assets and obligations for the liabilities relating to the arrangement. Joint venture, parties, joint venturers, have rights to the net assets. Accounting follows the classification. Joint operation accounting, recognize your share of assets, liabilities, revenues, expenses. Joint venture accounting, use the equity method. IPSAS 36. Example: 2 city councils build and operate a bridge. If they each own 50% of the physical bridge, asset, and each responsible for 50% of maintenance and loans, liabilities, that's a joint operation. Each council records 50% of the bridge on its balance sheet and 50% of revenues and expenses. If they create Bridge Corp to own and operate the bridge, and they have rights to the net assets of Bridge Corp, that's a joint venture. Each council accounts for its investment using the equity method. Main pitfall: misclassification. Classification should be based on substance, parties' rights and obligations, not just legal form. A separate company might look like a joint venture, but contractual terms could give parties most benefits and obligations, making it a joint operation in substance. Misclassification leads to fundamentally incorrect accounting. Careful analysis of underlying contracts is essential. IPSAS 38, Disclosure of Interests in Other Entities, acts as the transparency linchpin for group accounting. While the other standards dictate how to measure and recognize interests in other entities, IPSAS 38 specifies what you must disclose about them in the notes to the financial statements. The objective of this standard is to provide users with enough information to understand the nature and extent of an entity's interests in subsidiaries, associates, joint arrangements, other unconsolidated entities. It also requires disclosure of the risks associated with these interests. Essentially, it ensures that there are no hidden surprises within a complex group structure. The core rule of IPSAS 38 is to disclose information that helps users evaluate the nature, extent, financial effects of the reporting entity's interests in other entities. This goes beyond just listing names. The disclosures should explain the basis of control, joint control, significant influence. It also requires revealing the financial consequences of these relationships, including summarized financial information for significant subsidiaries, associates, joint ventures. The standard aims to paint a clear picture of the group's structure, the interdependencies between its members and the potential risks that could arise from these relationships. For a simple example, consider a national government's consolidated financial statements. In the notes section, as required by IPSAS 38, the government would provide a list of its significant state-owned enterprises, such as the national airline, electricity provider. For each, it would disclose its ownership percentage and explain why it is considered to be under government control. It would also present summarized financial data for these enterprises, such as their total assets, liabilities, revenue, profit or loss. Furthermore, it would need to disclose any significant restrictions on its ability to access or use the assets of these subsidiaries. A very common pitfall is providing boilerplate or insufficient disclosures. Simply stating that the government has interest in several subsidiaries is not enough. Users need specific, detailed information to make assessments. For example, failing to disclose significant judgments made in determining control, such as when ownership is less than 50%, can mislead users. Another mistake is omitting information about the risks the parent is exposed to from its involvement with other entities, such as financial guarantees provided to a struggling associate, commitments to fund the deficits of a joint operation. To make the consolidation process more tangible, let's walk through a very basic example. Imagine a parent entity, the Ministry of Health. It fully controls a subsidiary, the National Health Fund. We need to prepare a simplified consolidated balance sheet. We'll ignore income statements and just combine assets and liabilities. This shows IPSAS 35 consolidation logic in practice. First, their pre-consolidation balance sheets. Ministry, assets $500 including a $50 loan to the fund. Ministry, liabilities $150. Ministry, equity $350. National Health Fund, assets $100. Fund, liabilities $70 including the $50 loan from the ministry. Fund, equity $30. Step 1. Combine assets and liabilities line by line, add like items together. Step 2. Eliminate intercompany balances. From the group's view, this is internal, like moving money between pockets, so we eliminate the $50 receivable and the $50 payable. Final consolidated balance sheet, assets $550, liabilities $170, equity $350, $550 equals $170 plus $350. Mastering group accounting is a journey of applying clear rules systematically. To help you on this path, here is a practical checklist to review before finalizing your group accounts. Following these steps can help you avoid common errors and ensure your financial statements are compliant and transparent. Think of it as a final pre-flight check before you publish your reports. This simple list reinforces the key decisions and actions required by the standards we have discussed, from identifying the group members to preparing the final disclosures that tell the full story. Here is a short checklist for practitioners. First, identify your group. Have you identified all potential subsidiaries, associates, joint arrangements? Second, assess control. For each potential subsidiary, have you rigorously assessed whether the parent has control based on power, returns, the link between them? Document your judgments. Third, classify your interests. Have you correctly classified non-controlled interests as either associates, significant influence, joint arrangements? For joint arrangements, have you determined if they are joint operations, joint ventures? Fourth, align policies. Have you ensured that all entities in the group use uniform accounting policies for like transactions, and have you made adjustments where necessary? Fifth, consolidate and eliminate. In preparing consolidated statements, have you combined all assets, liabilities, revenues, expenses? Have you identified and eliminated all intercompany balances, transactions, unrealized profits? Sixth, apply the equity method. For all investments in associates, joint ventures, have you correctly applied the equity method in the consolidated financial statements? Seventh, prepare disclosures. Have you prepared the detailed disclosures required by IPSAS 38, explaining the group structure, the nature of the interests, associated risks? Eighth, review and verify. Have you double-checked your calculations and ensured that your consolidated balance sheet balances? In conclusion, the suite of standards from IPSAS 34 to IPSAS 38 provides a complete roadmap for public sector group accounting. Remember these key points. IPSAS 34 deals with the parent's solo reports, separate statements. IPSAS 35 is the driver of consolidation for controlled entities. IPSAS 36 and 37 handle partnerships where control is not absolute, using the equity method for associates and joint ventures and direct recognition for joint operations. Finally, IPSAS 38 ensures you tell the whole story through comprehensive disclosures. By following these rules methodically, you can produce financial statements that are not only compliant, but also incredibly valuable. Your next steps should be practical. Begin by mapping out your entity's entire structure of relationships. Use the definitions of control, significant influence, joint control to classify each interest. Then, apply the consolidation and equity accounting procedures step by step. Do not be afraid to seek expert advice when dealing with complex arrangements. Good group accounting is fundamental to public sector transparency. It provides leaders, citizens, auditors with a true and fair view of public finances, empowering them to make better, more informed decisions for the public good.